This episode is brought to you by Shopify. Upgrade your business with Shopify, home of the #1 checkout on the planet. Shop Pay boosts conversions up to 50%, meaning fewer carts going abandoned and more sales going cha-ching. So if you're into growing your business, get a commerce platform that's ready to sell wherever your customers are. Visit Shopify.com to upgrade your selling today.
Reality radio for a really great future. We're talking real money.
Feast your eyes on this. Audience,
Boy,
feast your ears on that.
I like to feast more than my eyes, yes.
That sizzling filet mignon that Tom is looking at right now. Oh,
that I will get nowhere near.
Yeah. I just got this in the mail today. Before we get to today's topic, I did want to talk about this.
Yes.
This is an invitation, to a well-known steakhouse here in Central Florida.
Ooh.
And where the menu, here's the menu. Appetizer is jumbo fried shrimp or a signature house salad. And for my entree, I get a choice served with garlic mashed potatoes of a center-cut filet mignon or cedar plank salmon or a double chicken breast. All I have to do is attend their exciting gourmet meal and learn about ways to obtain an income you can't outlive. Feel confident in your retirement saving strategies, financial strategies that may be used during challenging times, and how our clients have kept their money safe from market declines. Now, if I continued that last sentence, it would say using indexed annuities.
Yeah. And so you got to buy, you get the steak free, but you got to eventually purchase the index annuity.
Well, I showed this to Debbie before I came up to do the show, and she goes, "We can go if you keep your mouth shut."
Which would be basically impossible for you.
Here's my problem. I'm going to feel bad for all those people who might get ripped off by these guys. And by the way, I looked them up. This is what you need to do when you get these things, because a lot of them are not even registered investment advisors. And so I looked at their website, and here's what they offer. They offer retirement strategies. Now you think, well, strategies, that must mean investing advice, right? Annuities. Okay, that's a giveaway. Life insurance. Medicare. Okay, so they're doing health insurance. And get this, the last thing on their list, cremation services, because we'll do anything for a buck at this firm.
Does that come with the equity index annuity, or is that a separate purchase?
And I looked them up on advisorinfo.sec.gov, and guess what? They're not listed as a registered investment advisor. They are only, get this, only insurance agents who are pretending to be...
Which is unusual in today's business world, frankly.
It is?
Yeah, most of them are duly registered, or they have a RIA side of them. You know,
I'm telling you, that's going to lead to our main story. It's going to lead right into our big story of the day. By the way, our phone number, if you have a big question of the day, is 855-935-TALK, 855-935-8255. Because our big story today is an insurance company, a big one, a really big one, who has decided that selling you insurance isn't good enough for them. They are going to use their advisor network to help sell you private market products. Now, I'm going to assume that these people, the ones that they're going to use to sell these, had better be registered as advisors, although I'm not sure. I think that was
the point of it.
I'm not sure. It really doesn't say.
That's what I got out of it, that they were.
Okay, all right. So anyway, Lincoln Financial...
so you're right.
Lincoln Financial is going to go out and actively push private market funds.
Yeah, you get to invest in private credit. You get to invest in things like royalties on sports, pharmaceuticals, and brands.
Now, what's wrong with these? What's wrong with this picture? These products are often highly illiquid. They are usually incredibly expensive, and they are, or have been anyway, we don't know about the future, but they have been incredibly volatile and dangerous. And they have they have the kind of securities in their portfolios that could easily in a bad economy explode all over the place.
Yeah, I mean, and guess what? When you have 3,000 of these reps per state, that's did I get that right? No, I didn't get that right. 60,000.
60,000 all over the country. Yeah.
Yeah.
But it's these are people who sell annuities, life insurance, and other products. And
let's keep this going. There's a lot. It's 1,200 a state, so yeah. 1,200
a state, and they're working as if they're not making enough money selling you garbage life products. Now they're going to go into this.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
Welcome back to the show. Our phone number is 855-935-TALK, 855-935-8255. And we're talking about an insurance company, one of the biggest life insurance companies, Lincoln National, and how they are going to bring out some products by Bain Capital and Partners Group that are called private market funds. Now, Tom, again, let's kind of vaguely define what a private market fund is. What kind of stuff?
Well, I mean, I mentioned a couple of them. Well, okay, but a couple of examples would be the opportunity for you to invest in private enterprise that you can't invest in today. In other words, unless you are a business person who says, I want to invest in that business and do that as a business, it's hard to invest in companies that are not publicly traded, right? I mean, and there's a lot more private companies than there are public companies. And frankly, the number of companies going public has decreased. There's far fewer than there were 15 or 20 years ago. So this is part of the push is like, oh, you want to make sure you're invested in these private companies that are really great, but don't go public for a variety of reasons. So there's a lot of those companies. And are they riskier than the ones that are publicly traded? Well, yeah, they are because publicly traded companies have to undergo much more scrutiny than a privately held firm certainly does. But now, just not to Lincoln Financial, they're getting in the waters with some pretty big firms too, a Blackstone, Apollo, Ares. These are all folks that are offering investments in private companies, private credit, all these kind of things. But the reason I hate Lincoln, frankly, with a passion, is why are they doing this? And why are they unleashing 60,000 people on an unsuspecting public to push this product?
You nailed it, on an unsuspecting public. Because people trust these trusted advisors who are really mostly just insurance salespeople. And they are going to believe what they tell them. And they're going to believe that these are great alternative investments that should be in your portfolio, but they're only available now to the rich. Now poor people can get into these bad investments that, by the way, the cost on these things, I don't know about their new funds because they haven't come out yet, but generally it's about 2% per year in expenses for these products.
And they're going to tell you that the upside is awesome. They're going to tell you looking back 50 years, they've made more than publicly traded companies. Yeah, thank you. And that was one of the things that always comes to mind when these sort of things come out is you should never work with anyone who's pushing a product of any kind, ever, because they're incentivized. And I guarantee you these 60,000 quote unquote financial advisors will be greatly incentivized to push this new product in one way or another. You should never invest in ideas, which is what this is, right? This is a big idea that, as you said, Don, you got to add to your portfolio. And frankly, when it comes to investing, you should never trust an insurance company. This is not what they do. This is not the area they should be living in. And frankly, because they don't have to put your interests ahead of their own, no place for you to be taking advice.
No. And as a matter of fact, Lincoln National has been on a tear lately, introducing all kinds of, quote, innovative new products. They've brought out a ton of new variable universal life products, which, by the way, we despise. They are sold in such horribly misleading fashion and carry with them gigantic commissions to the agents who sell them. And these commissions are rarely, if ever. And when I say rarely, I'm really giving them the benefit of the doubt. When I say rarely, because it's probably, if ever, disclosed to you in anything but a large, thick, ponderous disclosure document, which they know you're not going to read. So when somebody's trying to push you into something, if you didn't go, actually, let me take that back a few steps. No one, even somebody you went to, should be trying to sell you a product from the get-go. If they're not learning about your wants, your needs, your risk tolerance, and all of that way in advance of suggesting any portfolio product, any investment product, then they are to be avoided like the plague.
Yeah, and coming up, we're going to be talking in the next podcast. We're going to be talking about those great products that look
next
like
hour of the show,
take it to straight to the moon, right? These are the really smart people. And my sense is private companies, private credit, all of this, you're going to look back in 10 or 15 years and say, what the world was that all about?
Yeah, they work right up until they don't. 855-935-TALK. That is our phone number. We want to talk with you about the money things you run into and help you avoid things like this stuff. And let's go to Cleveland, Ohio. Evan, you're up. Welcome to the program.
Hey, how you guys doing this afternoon?
Good, Evan. Thanks for calling.
Good. I had a question. So I have a couple different retirement funds. I have a Roth 401k and a Roth IRA fund. I think the Roth IRA is invested in an AVEG fund. And I was wondering, if I focus on investing most of my money in the Roth 401k, and I leave let's just say $5,000. I'm 32 years old, so let's just say I leave $5,000 in the Roth IRA, and I focus investing in the 401k. What could that $5,000 grow to within 30 years? Is it worth just leaving that fund alone? Or, what could you, let's just say in a worst case scenario, what could you anticipate that Roth IRA with $5,000 growing to in 30 years untouched?
And it's an AVGE.
I'm set to retire in 2055. Yeah.
Okay.
2055.
I'm set to retire in 2055, and I have two accounts. I have a Roth 401k.
We got it.
Hey, I'll be 99 then.
Most of my.
Yeah, we got it. You got the Roth 401k, which is great because at your age, all that money being saved post-tax, growing tax-free is wonderful. And then you got the Roth IRA, again, post-tax, growing tax-free, all in AVGE, which is the Avantis Global Equity Fund. So you're invested in a basket of diversified equities with a little bit of a leaning, if you will, tilt to smaller companies, to value companies, places in the market that people traditionally don't have much of their money exposed to. So how much is 5,000? Let's see, I could probably do it in my head.
We're going to use 10%. Okay, we're going to use 10%, even though
so that's
because this is a more aggressive fund, we're still going to come in low, about $100,000 at 10%.
Yeah, I was going to say, so is that worth it?
Wow. So you're saying if I only contribute to my 401k.
Yeah, and you don't ever contribute another penny to the Roth IRA. Yeah. Yep. $100,000 in 30 years.
And by the way, I'll make a pledge. You can call us in 30 years if it didn't reach that mark. So let us know.
Yeah, actually, no, because you could still be alive. You'd be 97.
No, I will not be alive at 97. So leave a message. We'll get back to you in the next, 2-3 years after that. So not a problem. Thanks, Evan.
Well, thank you very much.
Thanks so much for the call. 855-935-8255. That's talk there at the end. Give us a call and let's talk about money with you, your money, and how you can make it work better for you.
Tom and Don are talking real money.
This episode is brought to you by Amazon Business. How can you free up your team from time-consuming office tasks? Amazon Business empowers leaders to not only streamline purchasing, but better support their teams so they can focus on strategy and growth. Free up your teams and focus on your future. Learn more about the technology, insights, and support available at amazonbusiness.com.
For your real life and real future, Tom and Don are talking real money.
It's an important topic. It's your money, and you use it for all kinds of things, and we want you to save it better. We want you to not get ripped off. We don't want people to take advantage of you. We want you to do this better. 855-935-TALK is our phone number. That's 855-935-8255 every Saturday. And let's head down to Portland. Marie, welcome to the show.
Good morning.
Hi, Marie.
Afternoon. I have a couple questions. One is I want to tell you that I enjoy the transcripts on the podcast, and I frequently review those to see what the call numbers are on some of the things you recommend. My question is, do you monitor those to make sure they're transcripts?
No,
we got a guy in a dark room somewhere back east.
Where are you reading transcripts? I don't put transcripts up.
Yeah.
It must be Apple Podcasts. What?
They're automatically generated on Apple and Spotify and all those.
Oh, no, I don't look. I didn't even know that we got podcasts or transcripts. I'm going to look now.
Because they make
There's a guy in a dark room at headquarters that reviews them.
Transcribed.
I don't want to know, and I don't want to read them. That's going to make me feel bad. So,
let me just look at one.
Guys,
so far, it looks really good.
But look at March 7th, the very bottom where it says Apollo. They misunderstand you guys sometimes. My question was whether or not they mistranscribe the call letters when you do recommend something.
It is distinctly possible because that is something over which we have, even if we did review them, we could not change them because they come from Apple and Spotify. And I know for a fact that Apple is probably one of the most difficult companies to penetrate with any kind of critiques or criticisms. We get reviews that are totally off base, that are totally wrong, where they quote things we never, and we can't respond to them. So I'm pretty sure we can't do a darn thing about it.
Well,
so I would not attest to their accuracy. I would go back and listen.
Lately, the problem's been when you guys when it goes to an advertisement, it cuts you guys off and just goes over the top of you. So we miss a few of the things you're saying. Because
that's Spotify that's Spotify placing those ads too. So I am so sorry, but once we give our podcast off to Spotify, who their company actually uploads our podcast. Once we give that to them and it goes out on the web, everything else that happens is totally out of our control.
Okay.
I'm so sorry.
That's what I wanted to know about. Now, my other question is about bonds versus treasuries. When you're recommending bonds to people, does that also mean treasuries or just strictly bonds? Because I was told
it could be.
I live in Oregon, and they're saying that bonds cost me more taxes than U.S. treasuries.
That wouldn't be right, because you could buy treasuries, individual treasuries, or you could buy a bond fund that holds treasuries. Either way, that is going to be, the interest is going to be taxable any place, federally.
Okay. Yeah, but not statewide.
But treasuries do not get taxed at a state level.
But bonds do.
Regular corporate bonds do. Yes. So that must be what they're talking about.
Oh, maybe they're okay.
Right.
That could be.
Yeah. So you're going to make a little bit less money because you're going to have to pay state income tax on the income generated by those bonds. You will not pay state income tax on the income generated by a treasury because of reciprocity.
I have an idea, though. You could move to Washington and you won't.
Thank you.
Hey,
so when you recommend bonds,
river.
I could substitute treasuries without a problem.
Yes, you could. Yes, ma'am. Absolutely. And you won't see much difference.
Okay. I have one other question is basis points versus percentage. Isn't that the same thing when you're talking about cost of a fund?
Yes, ma'am. 100 basis points is 1%.
Yes. Yep.
100 basis points is 1%. 50 basis points is 0.5 of 1%.
Okay. And where do you find where they take that money out?
You don't. They take it out of the assets of the fund. They don't actually debit your account. It just comes out of what the fund is worth. You never see it. It happened totally behind the scenes. Thanks for the call. 855-935-TALK is our number. We've got a line open for you right now.
Tom and Don are talking real money.
My dad works in B2B marketing. He came by my school for career day and said he was a big ROAS man. Then he told everyone how much he loved calculating his return on ad spend. My friends still laugh at me to this day.
Not everyone gets B2B, but with LinkedIn, you'll be able to reach people who do. Get a $100 credit on your next ad campaign. Go to linkedin.com/results to claim your credit. That's linkedin.com/results. Terms and conditions apply. LinkedIn, the place to be, to be.
Reality radio for a really great future. We're talking real money.
Now she did it. I'm just going to sit around during breaks reading transcripts now. I didn't know there were transcripts to read. They're generally reasonably accurate.
I don't think I want to read them.
Yeah, but I mean, like, there's some words that they misunderstood. Bear in mind, it's artificial intelligence listening to the words we speak and trying to. Now I'm self-conscious because I know that it's going to be transcribing me soon, writing down the things
clearly
we say and not always getting it right.
How? And by the way, I got to ask because I've never gone through this before. Do the jokes deliver better in written form or are they better audibly?
You know, I read through one entire transcript, kind of skimmed it during the break, and I couldn't find a single joke. So apparently they're cutting those out.
Single funny joke you can find.
Well, okay, yeah, nothing made me chuckle.
The machine says that's not funny. Bye.
Let's see. And then you're going to start acting like we don't know. Funny. Might rhyme, might not.
I don't even know how you do that.
You go to Apple Podcasts and you pick an episode, and then you scroll down and it says transcript, and then you click the little arrow and it gives you the whole transcript.
You know, I think I'm going to make my kids do that.
I'm going to do a dramatic reading.
Or something.
Here, this is a recent show called Prices Also Fall.
Please, no.
I am so sorry. I don't think I did it as well the first time. I am just so sorry. I want to express my condolences to all of you who have suffered through the horrific stock market that we have experienced lately. I think I did it better that time because I had time to rehearse.
That's pretty close. Yeah, pretty close. By the way, I wonder now how the AI is going to analyze the AI that you just delivered from the previous.
AI.
This is a loop. Wow, that's going to be scary.
What a world we live in now. Oh, wow. Golly gee. 855-935-TALK. We love taking your calls because it's our favorite thing to do is talk with you. And we have plenty of time to do just that. So give us a call. Holler at me, at Tom, here, Talking Real Money. Now, let's go out to New Hampshire. John, welcome to Talking Real Money.
Well, hello there. It's a pleasure to talk with you two guys.
Well, it's our pleasure to greet you.
Well,
sir.
Thank you very much. I've listened to you guys for years, and love your podcast, too, because it's just not chock full of advertisements like so many of them are now. But that's a different topic. So I'm wondering, when it's time to start taking RMDs out of my wife and mine Roth IRA and traditional IRA, I'm like 5 years away. She's about a year and a half away. Can that RMD be treated like a Roth conversion and just moved into the Roth?
Can you take money from an individual retirement account out of that IRA, move it in the Roth, and count that as your RMD?
Correct.
Is that what I'm hearing?
Yes, that's correct, Tom.
I'm trying to think that through because obviously the money comes out of the IRA and it's going to be taxable. You'd have to have that would not be a conversion, no.
Oh, okay.
I don't think so. Don, I'm trying to look it up because that's so awkward. Sorry, you still have to have income to put money into a Roth. Yes.
You have to have money. You have to have income to put money into a Roth. Yes.
But you can do a conversion at any time. You can take the money out of the IRA.
Even if you're doing you can convert any time. To put new money in, you have to have income. But if you have an existing pre-tax IRA, you can convert it by paying taxes on the entire distribution.
Yep. And then put that in your Roth.
Put that in your Roth.
But that does not count for your RMD. And by the way, you mentioned something else.
Right, it cannot. It cannot count for an RMD. No.
And you mentioned something else.
That's specific. It cannot count for an RMD.
And you mentioned something else, John. You do not have to take a required minimum distribution from your Roth IRA.
Never.
There is no requirement there.
Oh, right. Yes.
RMDs are only from regular IRAs. John, thanks so much for calling. 855-935-TALK is our phone number, 855-935-8255.
Tom and Don are talking real money.
Still getting around to that fix on your car? You got this. On eBay, you'll find millions of parts guaranteed to fit. Doesn't matter if it's a major engine repair or your first time swapping your windshield wipers. eBay has that part you need, ready to click perfectly into place for changes big and small. Loud or quiet, find all the parts you need at prices you'll love. Guaranteed to fit every time. But you already know that. eBay. Things, people, love. Eligible items only. Exclusions apply.
Your guides to a really great financial future. Tom and Don are talking real money.
Just to finish the thought on required minimum distributions, a couple of things to pay attention to. Yeah, exactly. If you're born before 1960, you got to start taking them at age 73. That's one.
Yes.
Number two, you can't do a Roth conversion as part of a required minimum distribution, period.
However, if you do a conversion in advance, you can lower your distribution.
That's true. Number three, if you're born after 1960, you do not have to start taking the money out of your qualified accounts, IRAs, 401ks, traditional, until age 75.
And if you're born after 1965, you may never have any money left. Just the way things are going. So, hey, we want to help you out. If you're going after any of these jabberwocky brokers through the Tulgey woods, burbling everywhere they go with their phones, I'm throwing in nonsense words to see what I can do to the transcription.
Oh, mess with the AI.
I want to see what it makes of the words I just said that are all from Lewis Carroll. And
I'm sure it struggles enough with our show anyway.
It probably does. 855-935-TALK is our phone number. We're headed to Florida from New Hampshire now. Portland, Ohio, New Hampshire, Florida. We're all over the country. Bob, welcome to the program.
Welcome. Thank you very much for taking my call.
Our pleasure. What's up?
What I'm trying to figure out is how the Treasury TSPG fund fits into my overall portfolio. I understand it's a mid to short-term Treasury bond, but it trades like money. So I'm trying to figure out how it fits into my total overall allocation as a bond, whether it meets my requirement as a bond fund in my 60-40 allocation.
The answer is yes.
Mm-hmm. Absolutely.
Help us with the confusion.
Yeah, because it is.
Well, because nobody seems. Whenever I ask about it, nobody seems to know what it is, and some people seem to claim it acts like cash. But from what I can understand, it's a mid to long-term Treasury that I can cash out at any time. Is that not correct?
Yes, it's a weird portfolio in the way it's structured. But yeah, you can. It has intermediate term bonds in it, but because of the way it's structured, you can take money out and there's no fluctuation in value. It's a very unique fund.
And they do issue these bonds specifically for this fund. We cannot buy them. By the way, there's more more on the G fund that was just released, I believe, as part of the JFK assassination papers, page 5,473.
Some point
you'll
during
see
the
there,
show.
it's in there, so you'll just have to read down a little bit carefully and see the redactions taken out now, and you'll want to know that information.
And that joke's not going to work on the transcription either.
Wait for AI to have fun with that one.
Gotcha. All right, well, I appreciate your time because I was trying to figure out because anybody I talk to, they don't seem to understand what that product even is because it's a closed market and only.
The problem is people just generally don't understand bonds. It's this duality of risk with bonds. We understand stocks; they're just risky, but bonds, if you hold them to maturity and they're of high quality, there is zero risk. Problem is holding them to maturity. If you have to get out before maturity, they go up or down.
Yeah, right. And correct. And you saw that, of course, in 2022. As Don said, you've seen that a bit this year, though. I think an intermediate-term bond fund still ahead for the year. So, but that is a great bond fund. As I said, it's buys securities that we cannot buy, and it operates at a very low cost. So it's a good fund.
Good fund.
All right. Thank you very much.
You are so welcome. Thanks for calling. 855-935-TALK is our number. And now we're going to go to the Seattle area. Burien, John, welcome to the show.
Oh, hi, Don and Tom and John. I have a 401k with the city of Seattle, and I want to check and see if the allocations is good. I'm about 2 years from retirement, and I have like a Gilead Stable Value Fund, which is at 15.5%. Vanguard Institutional Total Bond Market at 15.5%. And Vanguard Institutional Stock Market Index Trust Unit D at 59%. And Vanguard S&P Small Cap 500 Index Fund Institutional Shares at 9.7%.
Okay.
I'm not loving that, no. And let me explain why. First of all, if you're a couple of years from retirement, you really should analyze how much you want to have in stocks or bonds. This sounds like a sort of a traditional 60-40, but most of the money's in large companies because the Vanguard
it's really more of a
fund,
70-30. It's a pretty aggressive portfolio.
And so I would examine the value there. You really have no international. So there's parts of the market that are not represented in this portfolio at all.
Yeah, and I apologize. Tom just cut out there for a minute because of his situation that we hope to alleviate next week.
Getting fixed.
His internet situation. But here's the thing. What I would like you to do first, John, and this is so important, sit down and determine when you retire what part this money is going to play in your retirement income. In other words, how much money do you need this to generate for you in retirement? If you don't need it to generate anything, that's one type of portfolio. If you need it to generate a lot, that's another type. So you have to do that. Then the second thing you do is go to talkingrealmoney.com just because it's easy and free and take our risk quiz. Determine what your tolerance, your comfort level is for risk. And then you're going to build a portfolio that is massively diversified in stocks for the stock portion and that is pretty safe on the bond side. Your bond funds are fine. I don't have a single gripe about your bond funds. They're wonderful.
Stable in total.
But what you're missing, I don't know the stock index fund you have, but that sounds like it's a U.S. Plus, then you've got the S&P 500. So you're way overweighted in the United States. And we've discovered lately, for the first time in years, why that's not a great idea. You need international, you need value, and you need to determine what your allocation is going to be, whether it's 50-50 or 60-40. Thanks for the call.
Tom and Don are talking real money.
You may get a little excited when you shop at Burlington. Burlington saves you up to 60% off other retailers' prices every day. Will it be the low prices or the great brands? You'll love the deals. You'll love Burlington. I told you so.
For your real life and real future, Tom and Don are talking real money.
Every single Saturday, we invite you to call us at 855-935-8255. 855-935-TALK. Thanks for being a part of this hour of the program. Remember, we'll be back on the radio, and then we'll be back with the podcast the very next day. And so you can still call us at 855-935-TALK, 855-935-8255. You can also go to talkingrealmoney.com and send in questions.
Trying to find a short one because we're short on time, right?
Well, we have about 2.5 minutes. Do you have one that short?
No.
Do you have anything important you'd like to share with our audience?
Oh, actually, I do have a short one. Pardon me, I just found it.
Oh, good.
Michelle writes us from Sammamish. Would like your opinion on REITs, real estate investment trusts, as an investment tool. They pay nice dividends. Thank you. Thank you, Michelle, for filling in for the 2.5 minutes.
Portion of your portfolio, REITs are wonderful because they are not directly correlated with
read
stocks.
what she just said.
But she's buying them because of the high dividend. No.
Yeah.
They can be just as dangerous as stocks. In fact, some of them, the high interest rate ones, are really dangerous.
Mm-hmm.
If they're up in the high singles or low double digits, I'd be running scared. The only way I'd ever buy REITs would be to buy REITs through a REIT fund like the Vanguard Real Estate Index. That's the only way I'd buy them.
They're an asset class that acts a little differently than stocks from time to time, not all the time. Yeah, they pay out all that money that a big part of it.
And that does help their stability as an asset class. But,
don't buy them because they pay high. Don't buy anything because it pays high dividends because there's associated risk.
You read an article somewhere that said these high dividend plays can help you create a retirement income. Never, ever, 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 ever do that. You don't create retirement income from one or two asset classes. You create an income from an entire portfolio from which you draw the income you need. This is where we're always putting the cart before the horse when it comes to money.
Yeah, I couldn't agree more. By the way, if you want to get your cart checked, we do that free of charge, right? I think we do.
Yeah. Tom will do it, or they'll do it at the border.
See how exactly.
They'll check your cart at the border.
So if you'd like a little help, free portfolio review, chat with an advisor, just go to talkingrealmoney.com, click on, this is going to surprise you, meet an advisor, because guess what? That's how we set it up. Yeah. So
what a coincidence.
And yes, we'll help you at least part of the way free. Sometimes people become clients. We love that, of course, but we'll help anybody get this right.
Just go to talkingrealmoney.com.
The opinions and views expressed on this podcast were current on the date recorded.
Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appellate Wealth. The views and strategies described may not be suitable for everyone.
This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction.
Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appellate Wealth, a fee-only registered investment advisor.
Please see Appellate Wealth's ADV Part 2A on our website for information regarding Appellate's fees and services.
Appellate Capital, LLC, DBA Appellate Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appellate does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit talkingrealmoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.